2 weeks ago, we released a video on our YouTube channel. It was titled, "The Developed World is on the Brink of Financial, Economic, Social and Political Crisis." As the headline suggests, it was a bit spicy and it contained some fairly alarming views. That video's gone viral. It's now, as we stand here today, had over 350,000 views on that single video. To put that in context, a good result for us would be 10,000 views on a video. In my mind, there's two ways to interpret this stunning result. Either we've struck a chord, and there's a lot of people out there that feel this way and genuinely believe that we're on the brink of a crisis. Or it's entirely possible that this view is widespread. Confirmation bias is prevalent, and much of the information in that video is already priced into today's markets. Now, I don't have the answer. However, clearly this is a subject, and I've spoken with many of you on the way in today, that is really front of mind for people, a lot of people nervous, and they want to hear what's going on. So today, as you hear our two teams present their side of the argument, as Tom mentioned, we've asked them to put themselves into an uncomfortable position and challenge some of their own views. I'd encourage you to do the same. Sit back and see if you can think about the other side of your view. See if you can think about the views that you don't hold and if it stacks up. If nothing else, I think it'll be a good and an interesting experience for us to go through. Now, the format, as we mentioned, is a live debate. The topic is, should you be risk on or risk off? And both teams have agreed that we're talking on a 12-month time frame. Speakers from each side are going to take turns to make their cases across asset allocation, fixed income and equities. We're also going to encourage some cross-couch banter and sledging to see if we can ruffle a few feathers. The team captains will then have 2 minutes at the end of the session to put the finishing pieces on their argument, and then we're going to ask all of you to show your vote and decide who the winner of today's debate is. But without further ado, I would like to invite Giselle to kick off the debate on the team of the risk off, and put your hands together for Giselle, please.
Thank you, James, and welcome to you all again from us as well on the winning side of this debating team. Now, imagine yourself that it's 5 years ago, as was earlier, about what the world looked like, and you'd gone on a very long holiday in a ship with no IT and arrived back in today's financial and economic world. What you would see is negative interest rates on roughly a third of the world's bonds. Monetary policy is totally exhausted. Interest rates have been cut. Central banks expressing frustration. Then you've got a falling business confidence, very hesitant consumers, and you're being told to take risky assets on board. Would you do that in that kind of environment? I think you might have second thoughts on that one. You might then turn the question around and say, well, what answers are going to be given? What's going to fix this problem that seems to be arising? You usually get two questions being offered or solutions being offered. The government's going to come and help you. Have you heard that one before? Fiscal support. They're going to rescue the economy by shoveling money back at consumers and households and businesses and expect the world to turn. Remember, America gave a big tax cut last year. It got the sugar hit, and today businesses are not showing the confidence that they would have expected to see after those kind of events. Are you going to wait for a trade resolution? Are you going to put your portfolio at risk of a Twitter feed to actually achieve an outcome? I don't think you'd want to put those risks as the answers to your investment solution. We know that the last decade has been substantially driven by falling interest rates and the continued benefits of globalization that we all enjoyed, and I think we kind of taken for granted, and I think we kind of appreciate just how important globalization's really been. Let's look at the local households. Highest debt levels in many years, highest debt to GDP in the household sector in the developed world. No wonder the consumers are not going to rush off and spend when their savings rate has also been coming down. We're seeing these widening gaps between economic trends and then financial asset prices, and within financial asset prices. Everything should give you time to pause, say, does this really make a lot of sense? Does this all ring true? Do I really think I can just continue as per normal? We don't think that's the case. What are you increasingly being offered? Higher risk assets on the promise of higher returns, or some kind of, she'll be all right, mate, growth will come and eventually those negative earnings will turn into positive and everything will just be fine. History shows that that just doesn't happen. There'll be no warning bell to tell you when things are going to change. You're going to get all kinds of false signals. You're going to get little calming rallies, and you'll say, that's not going to happen. No, it will, because things do repeat themselves eventually over time, and money moves fast, perhaps faster than ever, and you won't be able to move in time when that actually does happen. What exactly is risk-off in any event? Risk-off says economies are risky. I think we can all tick the box that the economies today look relatively risky in terms of trying to achieve the growth profiles that we became accustomed to and that underpin the financial assets that have benefited us for the past couple of decades. What is risky is when valuations just don't feel right, when you get a big differential in valuations between certain segments of asset classes, and that you know that that is unlikely to continue to be the case. It feels to me at the moment that many investors are standing in front of the bulldozer trying to rush in and pick up the penny instead of standing aside, put on your security vest and let that bulldozer pass you by. Protecting your gains has become really important. You've had probably close on 10% returns per annum for the last decade. Why would you not take some protection and bank some of those gains and take some of that risk off the table? It doesn't mean you don't invest. It just means you invest very differently to where you were before. I've been long enough in these markets, as I was kindly reminded, to very vividly remember the last 2007-8 period. And there was a famous quote by Chuck Prince, who was the CEO of Citigroup at the time, when he said, "When the music stops, things will get complicated." Then he followed on. "But as long as the music's playing, you've got to get up and dance." Take the second part of that quote to heart. That was just before markets tanked. Today, the musical chair is paying out again, and you don't want to be the last person standing. The tune is changing. Professional participants in the market will steamroll over you before you can move. It's time to take risk off. Thank you.
Thanks, Giselle. I might get the heating turned up a little bit after that. Thank you. Good way to start the event. Let's get straight into it. Bridget, up you come. Let's hear what the response from the Risk On team is. Thank you. Hands together for Bridget, please.
So do you all believe those views? Doom and gloom coming around the corner? Indeed, looking at my years of experience, the one thing that I hold to be absolutely sacrosanct are the underlying economic fundamentals. I ignore noise. And that's been exacerbated by Trumpion-like fake news at epic proportions. And it's distorting what actually is going on here, what is fact and what is fiction. Again, going back to core economic principles. And it's fair, I went to university a long, long time ago. But the news for you is that those principles still hold. And that is, recessions come from three things. Three. Inflation. Energy. And war. When we look at inflation, we actually have some inflation. The opposition's going to argue we have deflation. But we certainly don't have inflation that's causing central banks to want to dampen it and put us into recession. That's not there. Do we have an energy shock? Absolutely. But we've got a shale oil revolution. What does that mean? Lower systemic prices. Thirdly, war. No doubt we're going to be debating a ginormous amount about the trade wars. Again, let's be careful here. Let's not extrapolate trade wars into World War III. We could, but I think we've got to be careful, again, as to what is reality and what is pushing it beyond into fantasy world. So coming back to fundamentals, I'm just going to leave you with a few fundamental points. Central banks are supportive of growth and risk assets, and you're going to hear that in detail by Charlie coming up soon. Central banks got no interest in killing growth. They've learned from the past. They're smarter, they're bolder, they're far more on the front foot. Monetary policy does work. It works with a lag. We're only just unwinding quantitative tightening. Labour markets are strong in the G7. Everyone who's got a job wants a job. That means you're not forced into deleveraging. You're not forced into selling stuff. The other thing that I'll throw at you is this. Economic cycles last for a lot longer. Does everyone remember back to Greenspan? Does everyone remember back to that famous quote of irrational exuberance in December of 1996? Where was the NASDAQ at that point in time? 1,300 points. When did it peak? March 2000 at 5,000. How much did you lose? A lot. Could you have played it conservatively? Absolutely. But by being in risk off during that period of so-called irrational exuberance, boy oh boy, that came at an absolutely phenomenal cost. In terms of deflation, we are not in it. You're going to probably hear a lot more in coming months about Japanification. Japan is by itself, with ugly demographics, high debt levels. You've got another 190 countries globally that are growing. Let's just also put the canary out there. Trade is biting. We have and are flirting with a trade and manufacturing recession. But in our view, it's getting very, very close. Both sides want resolution. Politicians want to be re-elected, i.e. Trump. So both sides. China needs a deal in technology. US and soybeans and aircraft. It's quite simple. Actually quite simple. Neither sides want this dragging on. It's not in their interests. And the other point that I'll put at when I look at the economic imbalances, the banking sector has deleveraged. Sure, it may have awful growth dynamics going forward, and you'll hear a bit about that from Ben going forward. But the point being is, it's not going to cause a recession. On top of that, when I look at the other fundamentals, corporates still making profits. Household balance sheets in the US are phenomenal. And valuations, actually, when you compare them to the bond market, are looking very, very good. So in conclusion, the opportunity costs of being risk-off are just way too high when we've got central banks supporting growth. Everyone virtually who wants a job has a job. A trade deal looks imminent, and politicians want to be re-elected. After all, it's the economy, stupid. Thank you.
That was fabulous. Thank you, Bridget. And you called my bluff out in the foyer. You told me that you were very nervous, but clearly that was well rehearsed last night. That was a fantastic performance. Well done. I was going to bring in a little bit of banter here. Giselle, you remind me of one of my teachers scribbling naughty notes about me when I was sitting at the back of the geography class. It sounded like you were shaking your head and taking down a few notes for later on. Do you want to tell us what you're not happy about? You'll come later. All righty. We're going to hear from the fixed income side. Jay Sivapalan from Janus Henderson, back on the risk off.
Thanks, James.
Thank you.
Well, I've had the benefit of being an unbiased panel member sitting over there, able to listen to both Giselle and Bridget, and I must say, Giselle's a lot more convincing to me. Look, good afternoon, and thank you for your time, and it's great to be here as part of this panel, and thank you for inviting us. What I wanted to talk about today is really a few facts and figures about the bond market. Very few in the audience, and even I didn't realise that bond markets have been around for around 500 years, much longer than the share market. Yet bonds, over that full period, the entire 500-year history, had never had a negative yield. So central banks and markets are running a crazy experiment today. And I think I really want to emphasise that. The magic of compounding simply just doesn't work with negative yields. Meanwhile, we've had one of the longest economic expansion phases in modern history. In Australia's case, we've had 28 years of uninterrupted growth. In the US, 10 years, and so on. So the combination of these ever lower bond yields and the benign economic conditions is a perfect backdrop that's driven investors to become more overconfident and also chase more risky assets in search of better returns. So what does all this mean for valuations? Well, the byproduct of ultra-low yields is very high valuations on all assets, be it growth assets or defensive assets. Think of every asset class in terms of a price-to-earnings ratio. For a given level of price or given level of earnings, the price should be high if your discount rate or risk-free rate is low and is expected to stay low, which has been the case in the past decade. Now, this can be true for a company share, a residential property, or an infrastructure, or even high-yield bonds. But there's clearly not enough focus on the E side, i.e. the earnings, as part of that formula, and the sustainability of those earnings. There's a false expectation that as long as interest rates stay low, as Bridget pointed out earlier, that prices will hold up. But prices have a lot more to do with earnings, and the price will inevitably fall and falter when earnings falter. So what are the implications for investors, especially within fixed interest? Well, traditional bond portfolios built with the high quality, and I'm talking about credit quality here, and the defensive characteristics as a diversified to equities has been abandoned by investors in search of an array of credit income-orientated alternatives promising higher yields in this low-yield world. We would urge and argue that rather it's better to recognise the distortions of unconventional monetary policy today, i.e. those negative bond yields that never existed over the past 500 years, and invest accordingly, but not to throw the baby out with the bathwater. Now, buying negative yielding assets amount to punting that yields will become more negative. Sure, that can work out in the short run, but I think it'll struggle in the long run. So interest rate risk for investors needs to be carefully managed. Now, the hunt for yield is intensifying in a low-yield world, and that's understandable, but it's not necessarily prudent. As investors, we need to be compensated for the risk of permanent capital loss. Think back to Spain. Spain was one of the so-called pigs just 6 or 7 years ago, and investors punished Spain and wanted compensation for lending money or investing in Spanish government bonds. Today, at least out to 10 years, the Spanish government can borrow at 0 or negative yields. So investors are simply not getting paid or requesting a return or compensation for default risk. Now, over the past decade, and indeed over the last 3 or 4 decades, investors have enjoyed great returns from a number of asset classes, but in particular fixed interest. Fixed interest in Australia has delivered 8 to 9% on average over the last 3 or 4 decades, per annum compounded. So we think now's the time to really start focusing on the return of capital than the return on capital. Investors need to shift their emphasis to higher quality, less interest rate sensitive investments within fixed interest. Now, sure, this might forego some short-term performance, but it's likely to serve investors best over the coming decade. So I'd just like to close with a short story, if I may. In the late 1800s, well after the establishment of the bond market in America, bond salesmen back then weren't given company cars. In fact, for most states, cars didn't exist, but instead were given a brand new bicycle. They would ride around their respective states looking for prosperous storekeepers, tobacco farmers, druggists, and country banks. And these brokers sold bonds directly to investors. Now, no regulations back then, of course, so you can imagine the sales pitch. But they initially sold what were termed as prime bonds, in other words, good quality bonds, at yields of around 7%. The demand from these newly rich investors, private investors, was so strong that the yields on these bonds started to fall from 7% to 6, 5, 4, 3%, and so on. And that insatiable demand for income and yield meant that it opened up the issuance of what was considered back then second-grade bonds, in other words, lower quality bonds, issued by lower quality companies and utilities. Now, this went on until those lower quality bonds and their yields also fell to around 3%. Now, at the extreme, it also became very popular to issue longer-term debt, initially 50-year debt, then 100-year debt, and so on. Why not? Money was cheap for borrowers, and there was no shortage of investors who were so desperate to buy anything with a yield. Now, one popular bond that was issued back then had a maturity date of 2361. That's right, a maturity date of 2361. We haven't got there yet. We haven't even passed about a quarter of the time. Now, fast forward a few years, and about a quarter of those bonds that were sold on those little bicycles had defaulted. Another good lot suffered significant mark-to-market falls, often halving in value. Now, it all made good sense when everyone else was buying until it didn't. I'll leave you with that thought. Thank you.
Thank you, Jay. Captain of the Risk Off team, I'd ask your side to observe the countdown timer up the back of the room. No sneaking extra minutes in the debate, thank you very much. Our next speaker this afternoon, Charlie Jamison from Jamison Coot Bonds, is going to present the risk on side for fixed income. Please welcome Charlie.
Thank you. I actually have a lot of sympathy with Jay's arguments, but he's made the perennial mistake that most investors make. He's got the themes right, he's just got the timing completely wrong. He may even manage to speak a minute and 30 seconds longer than he was supposed to. A lot of those things are going to play out, but it's not going to be in the next 12 months for very good reason. Now, Giselle would have you believe that monetary policy is exhausted. We are right in the middle of utilising monetary policy all around the world. And the reason that we're getting this pre-accommodation is because central bankers are absolutely terrified of letting the genie out of the bottle. And I can prove that to you by just taking you through some actions in central banking land in the fourth quarter of last year, where we were told by Chairman Powell that we are a long way from neutral and likely to exceed it in October, in the early part of October. And that generated a risk-off moment in the fourth quarter. And very quickly thereafter, Powell appears on stage on the 4th of January this year with both hands in the air, side by side with Bernanke and Yellen, who he'd spent a lot of time trying to avoid up until that moment, put both his hands in the air and said, "I'll be as patient as you need me to be." Sorry for the little quick show of what's actually behind the curtain. And what is behind the curtain is the credit market. And it's so important to keep the credit market fluid. It is absolutely the oil that plumbs the entire financial system. And what happened in the fourth quarter of last year is that the credit market seized, and we didn't get any new high-yield issuance in December, and that absolutely terrified global central bankers. And so uniformly, all around the world this year, we are enjoying enormous accommodation well ahead of any kind of crisis moment, and it is that fact which will keep risk on for the next 12-monthly period. Monetary policy is exhausted, apparently. Well, we've had 17 interest rate cuts over the course of this year in developed markets for more than 1,100 basis points of accommodation. We are in a mid-cycle rate-cutting environment in Australia. We are going to have rate cuts from the ECB this week. We will very likely have rate cuts from the Federal Reserve next week, who have a huge amount of runway to continue to provide accommodation to keep risk on. If we turn to the domestic economy again, in the next 12 months, things look very healthy. We've had a status quo outcome in terms of our political environment that has generated status quo for the property market, for franking credits in equity land. We have had rate cuts delivered. We have had tax cuts delivered. We have had the currency materially decline and depreciate, which helps stimulate growth all across Australia. It certainly helps the export economies, and it holds back some of those imports. Just think about the last time you went to Disneyland, California. You're not going again anytime soon. But it will be a boon for the domestic economy, and we're already enjoying that. We know that we are going to receive further accommodation from central bankers as the year unfolds. We are really in the middle of this secular environment, which we must revalue risk assets under this incredibly low interest rate environment. Now, Jay's right, we are really making history as we're going along here. Negative interest rate policy is something you will hear a lot more about. Ironically, some of the very negative yielding assets that we hear about have actually been some of the best performing over the course of this year. Who would have thought that Switzerland, with a negative 1% yielding bond market, can generate total returns of 12.5% or more? But the reality is that this is going to stick around for a while. And what it's going to force investors to do is to continue to look for alternatives, to find income, and that will be very supportive of risk as that policy accommodation continues to get delivered to markets all around the world. We will certainly have more policy accommodation here. We are actively receiving policy accommodation right across the European complex. The US are now joining in. And it's not just, even if it is just an insurance rate cutting cycle, we know historically an insurance rate cutting cycle from the Federal Reserve is between 75 and 100 basis points of accommodation. That's exactly what was delivered in 1987, 1995 and 1998. We didn't go on to have any kind of recession, and the markets enjoyed keeping on. And it's very likely that we can continue to do that over the course of 2019, given the huge amounts of support that central bankers are prepared to provide to the complex. Thank you very much.
Thank you, Charlie. Our next speaker from the Risk Off team is Dr. Phillip Coughlin from Lazard Asset Management. We've heard the story from both sides that we're having lower rates in bond markets. It's having an impact on equities. Our next two equity speakers are going to tell you their view on what's playing out in that space. So thank you, Phil.
Thank you very much, James, and good afternoon, ladies and gentlemen. I'm going to argue here that when it comes to equities, you should be risk off, and you should be risk off for one very simple but very, very important reason. Assets are expensive and markets are frothy. Warren Buffett, I think, framed the current debating topic very well when he said that in share markets, you should be greedy when everybody else is fearful, and fearful when everybody else is greedy. And I'm going to argue that this is not the time to be greedy. Let me start with an obvious fact. Right? We're in the 11th year of the US bull market. That makes it one of the longest, if not the longest, in US stock market history. Over that time, prices have risen fourfold, and your total returns have been fivefold with dividends. And as a consequence, there's an enormous gap between the 50% growth in nominal US GDP over that time and what prices have done. Top line up 50%, prices up fourfold. And that has led us to the current position where the value of the US stock market compared to the size of the US economy is the highest ever. That's correct. The stock market capitalization in the US compared to US GDP is higher today than it was at all prior peaks and bubbles. Australia is a little bit better, but still overvalued, and we know that if the US falls, we'll fall with it. Now, every boom comes with a hot sector, and perhaps in 2007 it was the mining stocks. This time, of course, it's another tech boom. And I just want to talk about some of the signs and signals from '99 that are reappearing. The first one, of course, is just extraordinarily high multiples. The hottest sector of them all is the US software sector, and in that sector, the price-to-revenue multiple has gone up fourfold in this cycle. People are now paying 4 times as much as they did at the start of the cycle, and that means that multiples are now at a level which has not been seen outside '99 and 2000, the peak of the dot-com boom. Just like 20 years ago, there are lots of loss-making companies around, some with very large capitalization. And in fact, we've broken the record that was set in the dot-com boom 20 years ago of the percentage of US companies listing that are losing money. That's over 80%. And lastly, US companies have been gearing up in a balance sheet sense to a new record. Last year, for the S&P, cash levels fell 15%, debt levels rose 8% because company paid out more than 100% of their free cash flow in buybacks and dividends. That's great for boosting share prices, but you don't need me to tell you that that's not sustainable. Now in Australia, we've joined in enthusiastically with this boom, and today our tech sector trades on 38 times next year's expected earnings. The last time the sector traded that multiple was November 99. So perhaps we were a little bit earlier than the 1996 we heard about, a bit later than the 1996 we heard about. That was just 4 months before the dot-com bubble went bust. So we've seen a lot of this stuff before. It's not the time to be greedy. The time to be greedy was 10 years ago, when everybody else was fearful. Now, you'll, of course, find lots of people always in all these booms that will tell you, for some reason, it's different this time. But I think stock market history tells you that's a triumph of hope over experience. In this cycle, you'll often hear people say that, these US tech stocks are such wonderful companies, it's fine. But of course, that argument works at any price. And I think it's worth remembering that in 99, 2000, the Nasdaq was studded with the best tech companies in the world. They then fell 80%. Microsoft is probably the best software company the world's seen. It fell 75% from the top of that bubble to the low 10 years later. Valuations matter even for good companies. So in summary then, I think it's pretty clear to me where we are, and because we've seen all this before. It's hard to tell when it will end, but I think it's easier to say how it will end. I think it's fair to say badly. On top of all these high valuations, you've had some of the economic risks that Giselle mentioned, and some of these are genuinely new, in the sense that the trade war and the tech war are generally new. But you do not need an economic downturn to get bad stock market returns. We heard a little bit earlier from Charlie about 1987 and how there was a benign mid-cycle slowdown. Yeah, and the stock market halved. And there was no economic downturn whatsoever. The Nasdaq, too, started falling in March 2000. There was no catalyst, really. Really expensive stock markets are dangerous just by themselves. So you need to buy what's not hyped, what's not hot, what's not expensive. I think in share markets, this is not the time to be risk on or greedy. I think the time to be greedy was 400% ago. Thank you very much.
Thank you, Phil. Our final speaker for the debate at this stage is from the Risk On team. It's Ben Griffiths. He's going to talk to you about the case, the Risk On case for equities. Please welcome Ben to the stage.
Thanks, Jimmy. Thanks very much. Can you all hear me? Yeah. Thanks very much, Jimmy. I've got to say, ladies and gentlemen, I have the privileged position sitting on that lounge there that I have heard both sides, and I've got to say Risk On seems to be in front to me, but I'll let you guys decide that yourselves. I'd like to pick up on a comment that Tom made earlier about the valley of death, which he reflected metaphorically on. I see equities not at all in the valley of death or close to it. I see it actually enjoying the alluvial plains, some delicious loams. I see a backdrop or a landscape of quite fertile conditions for equities. Basically, to talk that through with you, Goldman Sachs publish a survey, a financial conditions index that they run on a daily basis that tracks how accommodative financial conditions are becoming or have become for equities. That trend has been loosening up for most of the year. And I guess forecasts are that trend looks set to continue. So financial conditions are becoming supportive of the bull case. I'd also refer you to the very basic risk curve that each investor in this room has reason to contemplate as they face the market. At one end of the risk curve, you have your cash investments, which I guess are earning around a 1% rate right now. Along that curve, you move to fixed interest or bond-like returns, where the 10-year bond in Australia today is about 1.05%. And at the end of the risk curve, in a simplistic way, you have equities, and you have, I guess, the market yielding around a 4% dividend yield, fully franked dividend yield. What is happening out there in the market, ladies and gentlemen, is that risk curve is shifting downwards as money moves up the curve and away from poor yielding assets in favour of equities. And essentially, we're going to see that continue as demand for stocks, for no reason other than the yield argument, continues to cut in. We've also seen, all of us have read reports where, generally speaking, I think on balance, the weight of opinion of investors right now, whether it's here or internationally, is somewhat negative, is somewhat bearish. People are anxious about the path for equities going forward with currency and trade wars, the economic backdrop, the yield curve. There is all sorts of angst out there, and I regularly see these investor surveys published which paint a fairly dour view of the way forward. That, for me, is one of the important preconditions for an equity investor. One needs to see a mood of bearishness out there, and I've certainly got that in place. No equity investor should ever front the equity market and look to write a check out when credit markets are flashing red, when yield spreads go haywire, as we saw in the GFC. It's important that credit markets are well behaved before one enters the equity market. And guess what? That's exactly what we've got right now. James touched on that a minute ago. I look at a handful of different spreads, whether it's high yield minus investment grade bonds, whether it's BAA less 10-year bonds, whether it's the overnight interbank swap rate less LIBOR, whatever spread you want to identify or nominate. From my observation, credit markets are in fact being very well behaved. That is a necessary precondition for equities to outperform. We're in very normal settings. The revered James Paulson, an economic strategist in the US that we spend a lot of time reading, talks about the importance of correlations to successful investing. Correlations basically are when you have a trend in one direction, how many stocks are going with that trend. Right now, the S&P 500 has a correlation of 0.35. In the last 18 months, it's ranged between 10 bips and about 50 bips. So we are generally positioned at the upper end of the correlation band. That is a necessary precondition for a stock market to continue to rally. You need strong levels of correlation. Bull markets mature on poor correlation when less and less stocks are a part of the rally or a part of the advance. The reality is more and more stocks are chiming in and being a part of the advance. So correlation continues to be strong. It's very hard to get too far away from valuation when you're discussing the plight of equities and the direction of equities. And equities, no matter which measure you use, range from being moderately high in terms of valuation through to tantalisingly attractive, which I can feel rankling there as I pass that comment. Moderately high in terms of PE ratios. Sure, the average PE ratio for the US stock market's about 15 times. At the moment, it's around 17 times. So we're moderately expensive. The equity risk premium is the one thing that I will hold up in terms of a bond allocation or an equity allocation sense that reinforces why equities are attractive. The equity risk premium in the Australian share market, which, by the way, an equity risk premium is that level of return an investor requires to make the investment in equities versus leaving an investment in cash. The equity risk premium in Australia is about 8.5%, an extraordinarily high buffer and incentive being given to investors. In the US, the equity risk premium sits at around 5.5%. It is worth noting, I'm almost out of time, I get it, it is worth noting that most major equity collapses and corrections historically have happened when the equity risk premium is about 2.5% to 3%. That's been the trigger point for an equity collapse. Again, the US market 5%, the Australian market about 8.4%. There's a generous buffer for investors. And finally, liquidity is moving our way. If you look at real money supply growth in the United States, at 1% growth in December last year, today money supply is growing at 3.3%. The simple yardstick is money supply growth less change in industrial production equals the liquidity that's available for financial market assets. That liquidity is growing, ladies and gentlemen, and the way I see it, it's going into risk assets, it's going into equities, and supports the case for risk on. Thank you.
Thank you, Ben. Well, ladies and gentlemen, you've heard the arguments from both sides of the couch, for risk on and for risk off. Very shortly, I'm going to ask you all to vote on what you think the outcome of the debate is. I just got word that the temperature in the room is risk on, which took me a little bit by surprise. There is a 60% bias to risk on versus 40% risk off, which I thought was quite surprising. But I'm going to invite Giselle up to come and make some Bridget first to make your closing remarks. They've got 2 minutes to put the finishing touches on their argument for the afternoon.
So what I'm going to do here is conclude by bringing along a couple of my mates. The first one here is called Mr. Bull. And Mr. Bull is full of vitality and energy. And as we've heard from the opposition, yes, he has been around for a while, but I'm telling you, he's still got fire in his belly. Go, Mr. Bull. I'm also going to introduce you to another mate of mine, Mr. Bear. Mr. Bear had a really nice big feast in Christmas of 2018. The only problem is he's ever so sleepy. Yawn. You want to go bye-byes? Absolutely. Okay, so I think we'll just go and put you back bye-byes. So, pulling out the pertinent points here. Central banks are supporting risk. Economic cycles last for longer. Everyone who wants a job, broadly speaking, has a job. We've got politicians who want to be re-elected. And we've got Mr. Bull still here with vitality. Indeed, the opportunity cost of ignoring this guy is going to be at the detriment of your portfolios, your stakeholders, and the community at large. Go, Mr. Bull, and vote for us. Thank you.
So, Bridget wants to tell us that we needn't worry about a recession. Maybe we don't need to worry about a recession in the old definitions, but as our team has pointed out to you, and in fact I think the other team did too, you don't need a recession to lose a lot of investment money. Put your hat back onto 2007-8. Did we have a recession in Australia? Nope. How much money did you lose in equity markets? Don't even think about it. That was a big, big number. Employment data is always backward-looking. People lose their jobs in recessions. They don't anticipate them. Don't expect employment data to tell you when this magic balloon is eventually going to burst. Charlie seems to think that we are in bondmarket.com bubble land, as Phil and our team pointed out. That is true. So now we've got this fake liquidity being supplied by the central banks trying to keep the whole bubble floating along. That's not going to last forever. And when are you going to be told? Is he going to stand here and tell you, I'm sorry, it's tomorrow, next day, 2:30 on Thursday morning? He won't know when that bubble eventually turns. No one actually knows that. And when we get to the equity market, we're told, it's fine, the corporate sector's okay, we've got this thing called the equity risk premium, just because bond yields are low, we should just pile into all kinds of other assets. There's one magic number that's missing in this exercise at all, the corporate earnings cycle. What have you seen from the Australian corporate earnings cycle in this last reporting period? What about the American corporate earnings cycle? Negative earnings growth in the last quarter. When is this earnings cycle catching up with the corporate sector that's no longer investing and the household sector that can't afford to spend anymore because their wages growth has been so low? All those kind of metrics that are telling you that things look fine have totally ignored the fact that equity earnings, corporate profits, go up and down. You can't just rely on backward-looking data and tell you that that will be fine. You've worked really hard for an investment portfolio. You've saved, you've invested for the last 10 years. It seems completely remiss to us that you wouldn't want to take some of that risk off the table now, not go and dwell in the Netherlands, not hide, but just take some risk off the table, treat your portfolio with the respect it deserves. Thank you.
Thanks, Giselle. I think before we get to the voting, I think I just have to put my hands together to all of you. I really appreciate you embracing the format that we put together. I know it was a little bit challenging. Some of you have had to go against some of your own views. I think you all did a fabulous job. Notwithstanding, there does need to be a winner. So if I could ask both teams to stand up, please. Ladies and gentlemen, we're having a little bit of, before you vote, the technology, the reception's not great, so we're going to vote with our hands and with an applause. Alrighty, old school. So I want to hear if you're camping with the Bulls, can we get a big cheer and a big round of applause, please? Woo! And if you want to hibernate with the Bears, could I put your hand together for the Bear team, please? Oh.
I think there's the numbers.
That's really tough to call. No. Show of hands. Shall we go show of hands? Okay, who's a bull? And you can only vote once. Who's a bear? We've changed the spots. I think I'm going to award that to the bear team. Congratulations.
Well done.
Great. Off stage. Thanks, guys. Thanks very much.